if we can go over what we talked about before, you said to me, I want to move from producing ounces to producing cash. Now that seems like quite an innocuous statement, but because most businesses, all businesses should be in the business of producing cash, but miners, especially when you get a little bit bigger, they forget that. They start plowing money back into the ground. They stop giving money back to shareholders. They stop doing things which are accretive in value. So can you just talk us around that time? Because you came back in and had a look at the company and came up with that idea pretty early on. So what were the things that you had to instigate and put in place? Again, this is probably for people new to this story, and a little bit for me, because I quite enjoyed it the first time around.
Yeah, no problem. We can rehash some of that. So just going back about a year and a half when I came back to the company as CEO, which we went through in my last interview and how I ended here. As you said, there was a real, I think, culture that had developed at the Asanko Gold mine where over this mine's been in production for four years, just over 4 years now of commercial production. During the first 3 years, the company essentially eroded its balance sheet. The mine didn't distribute any cash back to the parent companies, the joint venture partners, and any cash that was generated all went back into the ground in terms of capital improvements. And it was really actually a pretty decent EBITDA margin at the mine, with about 300 million in EBITDA generated over the first 3 years of production. All of that and some of the company's treasury actually got reinvested in the mine. And so last year we set about trying to make the most of those investments and looking at the development of the mine going forward in conjunction with our joint venture partners on trying to optimize the assets that we already have, which is a 5.4 million ton per year SAG ball mill, CIL processing facility, multiple open pit operations. And we came up with this plan we published it back in February in a new technical report. We've got a 10-year mine life, very little development capital being spent across that 10 years, producing anywhere between 230 and 250,000 ounces a year of gold at an all-in sustaining cost of just over $1,100 an ounce on average for those 10 years. And so obviously what this has allowed us to do is to really, instead of focusing on making the mine bigger and better, is focusing on generating cash flow. And I think that's really shown over the last 9 months. The last 3 quarters, the mine has distributed 95 million to the joint venture partners, so 47.5 million to Galiano's account, and that's allowed us to really repair our balance sheet, which was quite strained in the middle of last year with less than $10 million in treasury, to where we are today, which is a much stronger position.
Okay, but again, I just want to pick up on phrases here because we're trying to educate people as to what to look for in terms of fundamentals around business, and I think what you've changed is really quite unique. Very few companies that we've spoken to have gone at it like you have. So you said that, instead of trying to build a big and successful mine, we're focused on returning cash, but those two things aren't mutually exclusive. It's a question of how you go about building up a big and meaningful mine, how you allocate that cash, when you allocate that cash, and what the expectations are around the returns on that cash invested.
Absolutely. And so I think one of the most significant changes that we've made is really, again, the discipline around how you spend that capital and looking at the return on invested capital very carefully. And realistically, mining is inherently a capital intensive business, as I think we talked about last time. And there's really no way around, we will have to invest some capital, and you certainly see here in our second half of the year, we've got tailing storage facility lifts, we've got new pits that we're shifting into. There's sustaining capital that gets spent, but that capital is allocated carefully, and we target at a minimum a 15% rate of return at what we consider to be reasonable gold prices of $1,300 an ounce gold. And if you stay focused on that and really focused on generating that return, I think that brings that discipline. But also, what you need to avoid having unintended spends of capital is, and again, this is the second change that we really made, is in around planning. And if you don't have a good solid plan in front of you with where you're going, right now we're working on a really highly defined 3-year business plan. Ideally, that would be 5. A 43-101 technical report life of mine plan is not a business plan. It's an indication of what the asset's capable of. It's a backup for your reserve statement that shows that your reserves in the ground can be economically extracted, but it doesn't have all the details that are required to carefully plan out and allocate capital. And that's one of the biggest changes that we've made in the last year and a half, is really working on our forecasting, our budgeting, going back and looking back against the forecast that we made and finding out ways we went astray and where we could make improvements, and continually improving that forecasting and planning process and stretching it out from your annual business plan to right now we're working on the three-year plan.